Hi, we are beginning a new chapter called Redemption of Debentures. In this chapter, we will learn the methods of redemption of debentures as well as the provisions of the Companies Act 2013 with respect to redemption of debentures. Let's begin with meaning of redemption of debentures. Redemption of debentures means discharging the liability of debentures issued by the company by repayment of amount to the debenture holders or by conversion into shares or new debentures. What is the time of redemption of debentures? Debentures are normally redeemed on the due date, that is the maturity date. A company may, if authorized by the terms of the issue, also redeem the debentures before the due date or maturity date in installments by the draw of lots, and also, if authorized by its articles of association, by purchasing them from the open market, that is the stock market, for cancellation. How much amount is to be paid at the time of redemption of debentures? Now, in case of redemption of debentures in lump sum on maturity or installments by draw of lots, the amount payable is as per the terms of the issue. So, if the terms of the issue say it has to be redeemed at par, then the amount payable is equal to the face value of the debentures to be redeemed, and where the terms of the issue say that it's going to be redeemed at premium, then the amount payable is the face value plus the premium on redemption of the debentures. In the case of redemption by purchase from the open market for cancellation, then the amount paid on redemption is equal to the amount paid for the purchase of the owned debentures. What are the sources of redemption of debentures? Debentures may be redeemed out of capital, out of profits, or out of profits and capital. What is the meaning of debenture redemption out of capital? When debentures are redeemed without any transfer to debenture redemption reserve, then it is called redemption out of capital. So, which means in this case there is no transfer of any amount to debenture redemption reserve. Please note, as per the Companies Act 2013, it is not possible to redeem debentures purely out of capital. However, those companies that are exempt from transferring amount to DRR may redeem debentures out of capital. The list of the exempted companies we will be discussing in a little while. Out of profits, when debentures are redeemed after transferring an amount equal to 100% of the face value of outstanding redeemable debentures to debenture redemption reserve, it is called redemption purely out of profits. So 100% of the face value of outstanding redeemable debentures is to be transferred to DRR in this case. Out of profits and capital, it means that debentures are redeemed partially out of profits and partially out of capital. When debentures are redeemed by transferring amount less than 100% of the face value of outstanding redeemable debentures to DRR, it is called redemption out of profits and capital. Let's learn the journal entries for the redemption of debentures. We've seen that debentures can be redeemed at par or at premium. Where the redemption is at par, the first journal entry is to make the redemption amount due to the debenture holders. We will debit percentage debentures account to debenture holders account with the face value of the debentures, and that is the amount which has to be paid to the debenture holders because the redemption is at par. In the second entry, we will pay the redemption amount to the debenture holders. Journal entry, debenture holders account debit to bank account with the amount which is payable to them. where the redemption is at premium. For making the redemption amount due to the debenture holders, we will debit percentage debentures account with the face value of the debentures. We will also debit premium on redemption of debentures account with the premium on the redemption and credit debenture holders account with the amount payable, which is the face value plus the premium, since the redemption is at premium. And for making the payment to the debenture holders, we will debit debenture holders account and credit bank account for the redemption amount paid to them. The amount will be the amount payable, which is the face value plus the premium. Please note, at the time of the issue of debentures which is redeemable at premium, premium payable was credited to the premium on redemption of debentures account and a liability was established. So at the time of redemption, this account is debited and the liability is paid off. So the premium on redemption of debentures account will be debited and it will no longer appear in the balance sheet of the company. So we've seen the journal entries when debentures are to be redeemed at par as well as when debentures are to be redeemed at premium. We will go on to look at the provisions of the Companies Act with respect to debenture redemption reserve, followed by debenture redemption investment. Next, let's check out the provisions of Companies Act 2013 with respect to creation of debenture redemption reserve, or DRR. Let's check out the meaning of debenture redemption reserve. Debenture redemption reserve is a reserve which is created out of profits available for distribution as dividend, and it is created for the purpose of redemption of debentures. Let's go into the provisions of the Companies Act 2013 relating to DRR, or debenture redemption reserve. Every company issuing debentures shall create DRR except for those companies which are exempt from creating DRR. DRR is to be created out of profits which is otherwise available for distribution as dividend. As a result of transfer to DRR, there is a reduction in profits available for distribution as dividend. DRR is a specific reserve and can be utilized by the company only for the purpose of redemption of debentures. Transfer to DRR should happen before the redemption of debentures starts. The minimum amount to be transferred to DRR is 10% of the nominal or face value of the outstanding debentures. The company can, at its option, transfer more than the minimum amount, that is the 10% of face value of outstanding debentures, to DRR. Let's understand this with the help of an example. A Limited has issued 10,000 8% debentures of rupees 100 each, redeemable at a premium of 10%. Now, in this case, A Limited shall transfer at least rupees 1 lakh to DRR out of the profits which is otherwise available for distribution as dividend. And how did we arrive at the 1 lakh? It is 10% of face value of outstanding redeemable debentures, which in this case is rupees 10 lakh. 10,000 debentures multiplied by rupees 100 face value per debenture. So the total face value is rupees 10 lakh and 10% of that is rupees 1 lakh, and therefore rupees 1 lakh has to be transferred to debenture redemption reserve out of the profits which are available for distribution as dividend. we'll check out the classes or kinds of companies which are exempt from creating DRR. All India financial institutions regulated by RBI, all banking companies, all other financial institutions within the meaning of 272 of Companies Act 2013, all listed companies, and those unlisted companies, that is the NBFCs, non-banking financial companies registered with RBI, and housing finance companies registered with National Housing Board. So finally, we understand that only unlisted companies other than the non-banking financial companies and the housing finance companies are required to transfer to debenture redemption reserve. Besides the above, DRR is not required to be created in the case of fully convertible debentures, and in the case of partly convertible debentures, DRR shall be created only for the non-convertible part of the partly convertible debentures. So in case the debentures are to be redeemed by conversion, in the case of fully convertible debentures, no DRR is required to be created, and where the debentures are partly convertible, DRR shall be created only for the portion of the non-convertible part of the partly convertible debentures. Now, while calculating the amount to be transferred to debenture redemption reserve, any opening balance of DRR should also be taken into account. We will understand this with the help of an example. Let's say A Limited has outstanding rupees 10 lakh debentures due for redemption on 31st March 2021. So the company must transfer rupees 1 lakh, which is a 10% of rupees 10 lakh face value, to DRR before the redemption starts. Now, in case the company already has a balance of rupees 25,000 in DRR, then the balance to be transferred to DRR is only rupees 75,000, which is the rupees 1 lakh which is actually required, minus the existing balance of rupees 25,000. The amount to be transferred to DRR can be transferred in lump sum or in parts, but the required amount is to be transferred prior to the redemption of debentures. So where, let's say, rupees 1 lakh is to be transferred to DRR prior to the redemption of debentures, it can be transferred in one installment lump sum, that is the entire 1 lakh can be transferred in one go, or it can be transferred in parts, let's say in two installments of rupees 50,000 each. Now, as per the Companies Act, DRR has to be created out of profits which is otherwise available for distribution as dividend, and dividend itself can be paid by a company from general reserve, dividend equalization reserve, or surplus, that is a balance in statement of profit and loss. So the amount can be transferred to DRR from any of these two reserves or even the surplus. The journal entry for transfer of profits to DRR, to the extent it's transferred from general reserve, we will debit general reserve account. To the extent transferred from dividend equalization reserve, we will debit dividend equalization reserve account. And to the extent it is transferred from surplus balance in statement of profit and loss, we will debit the surplus account and credit debenture redemption reserve account for the amount which is transferred to debenture redemption reserve. Students should note that if the date for the transfer to DRR is given in the question, the entry should be passed on that given date, and where the date for the transfer to DRR is not given in the question, It can be passed on any date but prior to the redemption of the debentures. After the debentures are redeemed, the DRR can be transferred to General Reserve by passing the following journal entry: DRR account debit to General Reserve account for transfer of DRR to GR after the redemption of debentures. Please note, in case a part of the debentures are redeemed, the company has the following two options available. The first option is the amount of DRR proportionate to the face value of the debentures redeemed is transferred to General Reserve. And the second option is the company can wait for all the debentures to be redeemed and then transfer the full amount of DRR to the General Reserve. Now, where the question does not specify anything, in the absence of information, students should follow option 1, that is to transfer the proportionate amount of DRR to the General Reserve depending on the face value of debentures which have been redeemed. We can understand this by means of an example. Let's say X Limited has outstanding debentures of 10,000, 8% debentures of rupees 100 each, and it decides to redeem 2,000 8% debentures on 31st March 2021. Now, before the redemption starts, X Limited shall create DRR for rupees 1 lakh, which is 10% of the total redeemable debentures face value, which is rupees 10 lakh. Now, on redeeming the 2000 debentures on 31st March 2021, it may, out of the amount which is credited to DRR, in option 1, transfer the amount proportionate to the debentures redeemed, that is rupees 20,000, 10% of rupees 2 lakh face value redeemed, to General Reserve, and then the company will have a balance of rupees 80,000 in DRR. Or the second option is to wait for all the rupees 10 lakh face value of debentures to be redeemed and then transfer the entire rupees 1 lakh from the DRR to the General Reserve. And please note, where the question does not give any specific instructions, students should opt for option 1. The following chart will clarify the amount that has to be transferred to Debenture Redemption Reserve. In the case of exempt companies, do not transfer any amount to DRR. If the question is silent, then we need to transfer to DRR amount equal to 10% of the face value of outstanding redeemable debentures. Now, sometimes the question may say that the redemption should be purely out of profit, and in this case, we need to transfer amount equal to 100% of the face value of outstanding redeemable debentures to DRR. And in certain questions, the amount which has to be transferred to DRR will be given in the question, and in such a case, we need to transfer the given amount to Debenture Redemption Reserve. How do we know that the redemption should be purely out of profit? Please note, if either of these two phrases are given, then we know that it's redemption purely out of profit and 100% of the face value of outstanding redeemable debentures should be transferred to DRR. Either the question will say that the company decided to forego payment of dividend and instead utilize the profits for redemption of debentures, or the question may specify the phrase the company decided to redeem debentures out of profits. Debenture redemption reserve is shown in the equity and liabilities part of the balance sheet under the head reserves and surplus and main head shareholders funds. So we've seen all the provisions relating to Companies Act 2013 with respect to debenture redemption reserve creation. We'll move on to another important provision with regard to debenture redemption investment. We'll continue with the provisions of the Companies Act 2013 with regard to debenture redemption investment or DRI. Meaning of debenture redemption investment: every company issuing debentures other than the exempt companies shall invest an amount equal to 15% of the face value of debentures to be redeemed by the company by 31st March of the next year in specified securities on or before 30th April of the current year. The amount which is invested or deposited should not at any time fall below 15% of the face value of the debentures maturing by 31st March of the financial year. We'll understand this by means of an example. Let's say R Limited is to redeem 2,500 9% debentures of Rs 100 each at a premium of 10% on 31st December 2020 and also 2,500 9% debentures of Rs 100 each at a premium of 10% on 31st March 2021. Now the company shall have to invest 15% of Rs 5 lakh. This Rs 5 lakh is the face value of the debentures to be redeemed before 31st March 2021. Rs 2,50,000 to be redeemed on 31st December 2020 plus another 2,50,000 rupees to be redeemed on 31st March 2021. Totally, it's Rs 5 lakh. So 15% of 5 lakh, Rs 75,000 has to be invested in specified securities on or before 30th April 2020. The amount which is invested or deposited shall not be used for any other purpose other than for the redemption of the debentures. The specified securities in which the investment should be made are as follows. These are the specified securities where the investment should be made. Just have a glance through it. We'll move on to the journal entry for making the debenture redemption investment. Debenture redemption investment account debit to bank account for DRI made. The following class or kinds of companies are exempt from making debenture redemption investment. All India financial institutions regulated by RBI, all banking companies, other financial institutions within the meaning of 272 of Companies Act 2013, and unlisted companies. Those companies are non-banking financial companies registered with RBI and housing finance companies registered with National Housing Board. Hence, only listed companies and unlisted companies, those companies other than NBFCs and or HFCs, are required to make debenture redemption investment. So only these two types of companies are required to make the debenture redemption investment. Moreover, investment is not necessary for fully convertible debentures, and in the case of partly convertible debentures, investment is to be made only for the non-convertible portion of the partly convertible debentures. We'll move on to the realization of debenture redemption investment. A company having made the investment in DRI may 1. Realize the investment at the time of every redemption of debentures and invest again an amount that is not less than 15% of the value of outstanding debentures, or not realize the investment at the time of every redemption, but instead carry it forward as an investment in DRI for subsequent redemptions of debentures. We'll understand this concept with the help of an example. Let's say Z Limited is to redeem debentures of face value of rupees 3 lakh each on 31st March 2021 and 31st March 2022. Now the company shall invest rupees 45,000, which is 15% of this rupees 3 lakh, which is going to be redeemed on 31st March 2021 on specified securities on or before 30th April 2020. Now at the time of redemption of debentures on 31st March 2021, the company may, the first option it has is to realize the investment of 45,000 rupees on 31st March 2021 and reinvest the same amount on or before 30th April 2021 for the debentures to be redeemed on 31st March 2022. Or the second option it has is not realize the investment of rupees 45,000 on 31st March 2021 and retain it to be realized on 31st March 2022. Now, where the company chooses the second option, any of the following situations may arise. We have three situations. In the first situation, the DRI amount for the next year is equal to the DRI amount in the current year. We'll understand this by means of an example. Let's say A Limited has outstanding rupees 10 lakh debentures, rupees 5 lakh to be redeemed on 31st March 2021 and rupees 5 lakh to be redeemed on 31st March 2022. Now here the company will make an investment in DRI, rupees 75,000, which is 15% of the rupees 5 lakh to be redeemed on 31st March 2021. On 30th April 2020, it may not realize this DRI on 31st March 2021 and instead carry forward the same to the next year as investment for redemption during the year ended 31st March 2022. Now this situation is fairly simple. In the second situation, the DRI amount for the next year is greater than the DRI amount which is invested in the current year. Now in the same example, let's say B Limited has outstanding rupees 10 lakh debentures, rupees 3 lakh to be redeemed on 31st March 2021 and rupees 7 lakh to be redeemed on 31st March 2022. The company would have made an investment in DRI which is equal to rupees 45,000, which is the 15% of the face value of rupees 3 lakh to be redeemed on 31st March 2021 on the date of 30th April 2020. It may not realize this DRI on 31st March 2021 and will carry this forward along with making an additional DRI for the difference amount. The face value of debentures to be redeemed on 31st March 2022 is rupees 7 lakh and 15% of that is rupees 1 lakh 5,000. 45,000 rupees has been retained in the first investment made, and therefore the additional DRI to be made is for the difference amount of 1 lakh 5,000 minus 45,000, which comes up to rupees 60,000. So this is what has to be done when the DRI amount for the next year is greater than the DRI amount in the current year. Now what happens if the DRI amount for the next year is less than what has been invested in the current year? So in this example, B Limited has outstanding rupees 10 lakh debentures In this case, rupees 7 lakh to be redeemed on 31st March 2021 and rupees 3 lakh to be redeemed on 31st March 2022. Now we need to make an investment of first 15% of rupees 7 lakh, which is rupees 1 lakh 5,000. And in the next year, the required DRI amount is 15% of rupees 3 lakh, which comes up to rupees 45,000. Now the company will make an investment in DRI of rupees 1,05,000 on 30th April 2020. The next year, the company requires to make a DRI of only rupees 45,000, 15% of rupees 3 lakh. So it will retain rupees 45,000 DRI and realize this balance of amount of DRI, rupees 1,05,000 minus rupees 45,000, rupees 60,000 on 31st March 2021. So we've seen the three situations that will arise when we choose option 2. The first situation, the DRI amount for the current year is equal to the DRI amount for the next year. Situation 2, DRI amount for the next year is greater than the DRI amount in the current year. And situation 3, the DRI amount for the next year is less than the DRI amount in the current year. We'll move on to the concept of redemption in multiple installments during the year. We'll understand this by means of an example. Let's say X Limited has outstanding rupees 10 lakh debentures. It proposes to redeem the debentures as follows. Rupees 3 lakh debentures on 31st March 2020. Rupees 5 lakh debentures on 31st December 2020. And rupees 2 lakh debentures on 31st March 2021. Now the company must make an investment in DRI of rupees 1,50,000 on or before 30th April 2020. Because the total face value of debentures to be redeemed by 31st March 2021 is rupees 3 lakh plus another rupees 5 lakh plus another rupees 2 lakh. Total rupees 10 lakh and 15% of the same is rupees 1,50,000. This investment has to be made on or before 30th April 2020. Now we'll see how the DRI will be realized. At the time of redemption of rupees 3 lakh debentures on 31st August 2020, the company will realize rupees 45,000 DRI, 15% of rupees 3 lakh. At the time of redemption of rupees 5 lakh debentures on 31st December 2020, it will realize 15% of rupees 5 lakh, which is rupees 75,000 DRI. And finally, at the time of redemption of rupees 2 lakh debentures on 31st March 2021, it will realize rupees 30,000 DRI, 15% of rupees 2 lakh. So this is the way the realization of DRI will happen when there is redemption in multiple installments during a given year. Next, let's check out the journal entry for realizing the debenture redemption investment. The company receives cash, so the bank account will be debited to debenture redemption investment account for the realization of debenture redemption investment. Debenture redemption investment may earn income which may be subject to TDS or tax deducted at source. TDS so deducted is an asset for the company since it is deducted out of the income earned. The journal entry for income earned and TDS. Bank account debit for the amount which is received in cash. TDS receivable account debit for the asset because the TDS has been deducted out of the interest earned. To interest earned account, the income account is credited. Narration, interest earned on DRI and TDS deducted. At the end of the accounting year, the following journal entry has to be passed for the transfer of income earned to statement of profit and loss other income. interest earned account debit. 2. Statement of profit and loss, other income, for the transfer of interest earned to statement of profit and loss. So these are the two journal entries that need to be passed for any interest earned on the debenture redemption investment. So we've seen the provisions of the Companies Act 2013 with regard to debenture redemption investment also. Next, we'll move on to the methods of redemption of debentures. Methods of redemption of debentures. Debentures may be redeemed: 1. On maturity in a lump sum, or second method in installments by draw of lots. The third method is by purchase from the open market, and the fourth method is by conversion. The third and the fourth method, which is purchase from open market and conversion, both these methods is not there in the CBSE syllabus. So now in this video, we've learned the provisions of Companies Act 2013 regarding redemption of debentures, and we've seen the 4 methods of redemption of debentures also. In the upcoming videos, we will learn the journal entries to be passed in the first method, that is on maturity in a lump sum, as well as in the second method in installments by draw of lots.